welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, Paul. Good morning, and good morning to all of our viewers and our listeners out there. If it's Tuesday, we're talking real estate. I want to welcome everybody back for another week of exciting and what I hope to be less volatile times for this week than some of the past several weeks, and a very happy springtime to everyone out there wherever you are in the country. It should be getting a little bit warmer. I know here in Southern California the rain has subsided temporarily. We hope, while we love the rain and need it desperately, we got a little too much, and it's been cold. So I'm hoping we're getting in springtime, flowers are in bloom, and we're here talking some real estate. I'm Barry Saywitz, president of the Saywitz Company, managing partner of Barry Saywitz Properties. And today we're doing a little different show. The guest is me. Paul will act as our sort of moderator. We're going to have a candid discussion about some of the things that are driving the real estate market and the overall economy and how those affect the real estate market. We've been talking about doing a show like this because there are so many things that are affecting what's going on in the world today, and right when we think we have a handle on it and something stabilized, something else comes along. So today we thought we'd talk about what are the headwinds that we're facing in the overall economy, and then how that relates back to the real estate markets, both here in Southern California and elsewhere around the country. So, Paul, welcome.
Thank you for letting me ask the questions on my mind and everybody else's minds here. Let me cut right to it here. We're doing this in April of 2023, and this morning, CNBC ran an article that said, coming commercial real estate crash that may never happen. And if that's not confusing, let me give you some of the stats why they're confused here. They quote SL Green and Company, chief executive. They're the head of New York's biggest commercial landlord, and just recently told Wall Street analysts traffic was finally picking up. Their office space was looking better. They're coming out of it. And he said, we are full guns blazing. And then a little thing called Silicon Valley Bank happened.
Yeah, I mean, again, I think you've got to take it in pieces in terms of what's going on. We talked about it on, I think, last week's show and others. The office market really is coming back. I don't know about guns blazing, but it is certainly better than it was 6 months or a year ago, or even 90 days ago. There's more activity, more companies are bringing their employees back to work. And then the companies who couldn't make long-term decisions in terms of growth and in terms of how their office space would look or work during COVID, because they couldn't see the end of COVID or how that impacted them, I think people are now in a position where they can make decisions. I either need an open plan, or I don't want an open plan, or I need less space, or I finally need more space. And so the activity in the market from everyone that I've talked to, it has definitely picked up on the office side. And so I would agree with that gentleman's comment. The flip side of it is nobody needs other disruptive factors that are going to derail people's decision making or growth plans or the perception or reality that we would go into a recession.
Did Silicon Valley Bank hold that much commercial notes or loans? I thought they were mostly tech companies.
No, and again, I'm no prognosticator, but Silicon Valley Bank is not every bank in the country. What it is it's a bad thing to have a bank go under and a bunch of people lose a bunch of money and then have it impact other banks like it did to First Republic, because they were vested in it.
Credit Suisse, all these other specialty banks suddenly were getting bailed out.
So banks that were heavily vested in riskier real estate or riskier sort of formats, if you will, have problems with cash, and nobody wants to go back to where we were in 2008 to 2010, where you have banks going under and you have B of A stock at 2, right? And so with First Republic, their stock went from something like 110 down to 15 last week. And so it's a horrible place when people are scrambling, panicking to pull money out of their bank or protect the money that they have, and no one knows that better than me firsthand. And so I'm glad the government stepped in. I'm glad they reacted quickly to it to try and quell the mass panic. But nonetheless, we have to get past this so that people don't think their bank's going to go out of business or start running around. I do think you're going to see more consolidation in the banking industry, and you're going to see some of these banks that are not shored up get gobbled up by somebody else who is more healed. And in the case of First Republic, you saw 30 different banks or something like that invest money or put money into First Republic, and there's a very good chance that that money would get converted into equity or have to get extended so that they're, for lack of a better word, propped up so that there's no panic. But what that does is it just changes people's perceptions of, are we at the soft landing? Are we out of this thing? Are we past COVID? And then the news just exacerbates everything and makes the average person's perception, a panic, because they make it look worse than it maybe is.
Just had Fred Whitaker in here, big attorney in town in Orange County, and certainly well known as the long-term chair of the Republican Party, and he kind of felt soft landing was in the making here. Does any of this make people doubt that?
Well, look, again, you have people say soft landing. You have some people say, hey, we're on the road to recovery. But you have many other factors that potentially can either prolong or derail the perception that things are warm and fuzzy, right? They're not warm and fuzzy. I don't kid yourself, right? They're not horrible, but I don't think anybody goes to bed going, oh, we're out of the woods and everything's fine. You have inflation. Right? The question is how much and to what degree. You have labor issues, you have unemployment issues, you have employee issues of people looking for better jobs or not wanting to work or only wanting to work from home. You still have a volatile stock market as a result of everything that's going on. And all of those things play into what happens in the real estate markets, both on the residential side and on the commercial side, because it's my expectations and my long-term planning.
Well, the Fed Reserve Chairman, Jerome Powell, stressed that the collapse of Silicon Valley Bank and Signature Bank were outliers and had nothing to do with real estate. Silicon Valley Bank had barely 1% of their assets in commercial real estate. But I think people were afraid that it was the canary in the coal mine. It possibly portended, there's a fancy word, suggested more was to come.
Well, look, you also have the perception that if it's a Silicon Valley Bank was not a community bank, but certainly was a smaller regional bank heavily vested in riskier deals. And
specialty bank.
Venture capital, private equity, Bitcoin, right? Other things like that. But I've had conversations with folks and they say, well, I would never put my money now with a community bank. I need a big bank. I need to feel safe. I want to go with one of the big, the big ones.
Right.
And that's crazy, because you need the community banks to be able to make the loans and have the relationships with the community businesses. So as a small business owner, you maybe don't fit in the box at a big bank, or you get lost in the shuffle. You have to have community banks. Now, I do think you're going to see some of these community banks consolidated or get gobbled up, and some may just go away because they're not in a position to be able to weather whatever storm is coming. But you're not going to see them fold up and have people lose money. So to think, oh, you're only going to have a bunch of big banks is also crazy. I mean, and that's what happens when you get news coming, left and right, and you have sort of, panic. And so people have to calm down and take a deep breath. But it's hard to do that when new stuff comes out all the time.
So I'll push you one more time here. From the same article in CNBC, they suggest that almost a quarter of mortgages on office buildings will probably have to be refinanced this year, according to Mortgage Bankers Association data. That's a big chunk. They're estimating there's $3.1 trillion in commercial real estate loans, says Goldman Sachs, out there right now. A quarter of them have to get refinanced, and at a higher rate.
Yeah. So again, you have to take it with a grain of salt. I'm sure that statistic is true or close to true, but think about it for a second. If the typical commercial real estate loan, and not all of them, but typical, is for 5 years,
right,
and the rate is fixed for 5 years, you divide 100% by 5. That's about 20% a year where loans roll, regardless of what the rates are, regardless of what the economy is doing. So for somebody to say 25% is rolling, sure, I don't disagree. But that was going to happen regardless of what's going on in the rest of the economy. Now, the flip side is if those loans are rolling and they were fixed and now they have to refinance at a higher rate, yes, there is an event coming, and those people will wind up paying more because their mortgage is now going to cost them more money. If they had adjustable mortgages, then they may have been adjusting up as we went along the way. What you read about is if my rate doubles from where it was, if it went from 3 to 6 or 3.5 to 7, and my mortgage payment doubles, and I cannot raise rents accordingly, or I cannot fill the building because it's still struggling, I'm going to have an issue. And so then you're going to get back to, do you have well-heeled landlords that are going to be able to stomach and weather the storm? Do you have sophisticated landlords that just give it back to the bank, which happened here in Los Angeles? They just said, I can't do it, right? It's not worth it for me. I'll just walk away. And so now, again, people jump on it and say, hey, this is, just a panic and an unraveling of the market. And it's not an unraveling. It's just an evolution of the market for the next stage of what's going to happen. But the smaller guy who bought the property predicated on a 3% interest rate, who counted on 3%, who didn't think, didn't save, didn't reserve, didn't wonder what would happen if one day that went up, that's the guy that's going to have a problem as it comes. And that's going to happen whether it's an office building, medical building, retail center, apartment building. You're going to start to see that. The difference is we are only 1 year into interest rates rising, not even. And so somebody who fixed their mortgage last year for 5 years, that event won't happen for a while. And so it'll be interesting to see how that goes, but money costs more and people are going to have to pay more as a result of it.
What is, I don't understand the complexities of these high-rise office deals. What do they have to maintain? What's their break-even point? How much vacancy can they exist with?
Right, and there's no magic number because every deal is different. But what I would tell you as an office building owner ourselves, you have costs go up through the roof. You have gas here in Southern California for the wintertime because it was so cold go up 400%. Natural gas. You have janitorial services go up. You have electricity from Southern California Edison, trash. And then all the vendors, right? Everybody raises their prices because they have to pay their people more, or their workers' comp goes up, or their own operations go up, or their own rent got raised. So they try and pass it back on to the consumer or to the clients. So if my operating costs as a whole go up and my rent either stays the same, goes down a little bit because of COVID, it's not keeping pace with the expenses. Taxes go up, insurance going up 10, 20, 25%. Everything's going up and I can't keep pace. And the tenant says, hey, I don't really care. I'm not going to pay more just because your expenses are going up. As a landlord, you're getting squeezed. Now, the converse of that on the industrial side, if you have a triple net lease or a retail lease where it's triple net, you just pass all those expenses.
Exactly. We're just talking offices right here.
So
that doesn't get passed
so I think that you're going to see, in the office market, when it does come back, you're going to see landlords push the rents back up as quickly as they can, not because they're trying to rip anybody off or make a bunch of money. They're just trying to cover the costs. But again, in the meantime, people are going to have to hunker down and try and get, through the storm, if you will.
Well, you had the vice chairman of Cushman & Wakefield on a while ago. He was optimistic, of course, because that's their business, and maybe because that's what they're seeing. But they apparently admit in this article that office building vacancies rose to 18% in late 22, topping 20% markets like Manhattan and Silicon Valley here. I just wonder if these loans can, how long will they keep paying these loans if there's that much?
Well, again, you have to take the statistics again with a grain of salt. If vacancy is at 20%, how much of that are people that actually aren't paying on the vacant space, or is that just vacant space? So if I was Citibank and I gave up a bunch of space because I had people working from home, I'm still paying rent on that space. So I'm not sure that number is as high as you think. The other side of it is when you start to look at other markets, Manhattan's a different ball of wax, but you look here in Southern California in the suburban markets, and if I had 15 or 20 things to pick from as a tenant, that would mean the market's fairly soft. If I had more than that, it would be even softer. What's happening is there's less options, and then there's less good options. And so you are starting to see more activity, and you are starting to see the number of options decrease, which is a positive sign for the office market. So, I say, look, the more people come back to work, the office market slowly will recover. It is not a quick fix. and the interest rates of what happens to them is not going to affect what tenants do and whether they need space or not. It's not a direct correlation.
So last question, as banks look ahead at their commercial portfolio, whether it's small or large, will they start keeping more money on hand to protect against losses, which means fewer loans, harder loans, more difficult loans for that sector?
Yeah, again, I think the banks that were doing that already aren't going to change their MO. I think that banks that had less cash on hand are going to go relook at what they need to do to shore up their balance sheet to make sure they don't end up like somebody else who had problems. But it was already more difficult to get loans. Banks still want to make loans. They have to make loans, and if they're making them at today's interest rates, those are good numbers. The issue is nobody's going to take super risky loans. I think you're still going to see loan to values much lower, and you're going to see banks really look at the borrower and the deal instead of just handing money out like candy.
Well, the good news, too often we get focused on the bad news, as you say, and that becomes our reality. As this article points out at the end, industrial, retail, and hotels are solid. This is just one sector of the market that seems to be of concern at the moment here.
Yeah, but they're talking about solid relative to interest rate fluctuations and relative to vacancy.
Right.
I mean, again, I think all of these things go back into what's going to happen to the economy. Are we going into a recession? Is it a soft landing? Are we continuing on an upward movement or not? And I guess the proof is in the pudding. It remains to be seen. But you do have other issues. I mean, I've seen it in my own office. I've seen it just talking to other small business owners where if you rewind a year ago, very, very difficult to hire talent, good talent, very limited number of opportunities. We recently were hiring for a position and got over 100 resumes. Now, they weren't all good.
But you got that many.
But
right?
we got that many, which was, that might have been 20 resumes a year ago. And so I think there's people out there still looking to move around to try and get either more money, better job, better benefits, whatever's important to them. But as an employer, you're also trying to look for talent that is good talent that will add value to your business and that's going to be loyal and stay with you. I mean, the whole movement around as an employer is just not a fun thing. And I think as the economy continues to struggle, putter, whatever you want to call it, I think employers will value good, hardworking, productive, value-adding employees. And as an employee, you really should value, the fact that your paycheck is going to clear every couple of weeks and that you have a company that's not going to send out an email and fire a bunch of people in a day. And I got to go figure it out.
Well, I'll tell you what confuses people like me who sit in this chair and listen to people come in week after week and say, oh, soft landing. No, hard landing. Oh, it's getting better. No, I'm not so sure. Is this conflicting anecdotal data that I get. On the one hand, I keep reading that unemployment is still at record lows. The jobs reports keep coming in great, despite what everybody says. And yet, anecdotally, I hear people saying, like Fred Whitaker was here last week or a couple weeks ago, said, I'm thinking about not replacing this latest person that left. Not sure. I hear people still laying off. Certainly tech companies and whatnot are laying off like crazy still.
I think, you as a business owner, you're constantly looking at overhead. Everything is going up around you. So if you've got somebody who's not adding value, if you've got a position that can be replaced or their services
or eliminated,
or eliminated, then you're going to look to do that. I mean, there's only so many places where you can start to cut costs. And then the issue is if I can't cut costs anymore, all I can do is try to pass some of that back on to the next guy. So if I'm a law firm, I raise my rates. If I'm a restaurant, I raise the price of a cheeseburger, right? I mean, as Starbucks, I think the one I go to, I think they raised their prices like 3 times in the last 30 days. Yeah. Every time I go, it's more money. And I'm like, you guys just raised the price again? You just raised it last week. And
I was just looking at the Bowers Museum in town here. I love going to some of the artsy things that they do and have some usual exhibits over in Santa Ana. $3 they're raising their rate. I think it's like, that's got to be 10-20%
right. It doesn't seem like a lot, but I mean, even if Starbucks raised the price of a cup of coffee by 30 cents a cup, it could be something to the tune of 20 or 20% increase. And
went to the grocery store with my wife the other day. First time I'd been to the grocery store in a while. I rate, put in the thing, it's $160, and instead of 3 bags, I got 1 bag.
That's what happened to me last night. I had 1 bag of stuff. It was $95. I'm like, what the heck did I buy?
Yeah, exactly.
So
no booze in there. There's nothing
No.
expensive. Yeah, right.
No. And so these are the kinds of things that are real life. So I think you're going to start to see people peel it back and not go out to eat as much and not spend as much and not buy 3 of something and just buy 1 or whatever the case is. And you see that on a daily basis. And then you see the coffee talk of what's, going on with people where they talk about perception, and then that becomes a reality. And so if we come full circle and we relate that back as to how those kinds of things relate back to the real estate markets and what happens, the real estate is driven by people's actions, people's perceptions, and what's going on in the overall economy around you, in addition to supply and demand, right? But other things will affect what happens in the market. So you talk about the housing market, are prices coming down? Is there flexibility? Is there less activity? I say, yeah, all the above. Right? Is it a crash? No, it's not a crash, but I mean, it's definitely a different market and a different perspective. Now, if you look at the commercial markets, you have to take it in pieces, and you have to look at what the submarket is that you're in, what the type of product that you're in, and what you're doing. And I'll give you an example. So you have office space. The office market, I think, in a general sense, is on its way back, but still has certainly ways to go.
Right. It's the weakest of the 4 or 5 categories in here. Right?
The industrial market, I believe, has hit its peak, and while it is still super high and there's still super low vacancy, and if I was a big industrial landlord, I would say, no way, Barry, everything's just rosy and we're all good and it's no problem, because they are 99% full. Right. They are still raising rents, and as those people's leases continue to roll, they will continue to raise the rents to get everybody up to this new norm.
Reaching a point where the tenants can't pay anymore.
And some won't. And so what will happen is then, what we're starting to see both on the apartment side and on the industrial is one guy says, look, I don't need the last dollar. I don't need top dollar. I just want it filled.
Yeah.
And go get me X, right? And if X is the market, get me just a little bit lower than X. The problem is that then drives the market for the next one. So so now somebody rents space at less than what the last deal was, not more. And then the next guy says, look, I have the same MO. Look, if the last deal got done at X, give me X minus 10%. And then now the perception is the market is falling, when it's really not, right? But people's perception is that it is, and they use that in their thinking. They use that in their negotiating. So apartments, I met with one of our tenants last week, and they said, you just raised my rent 10%. And, the economy, this and that, and I didn't get a raise, and, all the excuses as to why we should just keep the rent exactly where it was. And I said, but you are 30% below market, your rent got raised 10%. And they said, well, I found a cheaper place down the street. Will you just let me out of my lease so I can move down the street? And I said, no, you can't do that. And then they said, but that's the market. I said, that's not the market. Here's 10 things in the market. You found one where somebody's desperate.
Yeah.
Everything else is more than what you're paying. So don't do that. Now, if you would have rewound 6 months ago, they wouldn't have been able to find that one, right? And then they would have zero argument for it. But it's starting, right? And so we have tenants calling up going, hey, my hours got cut, or I got laid off. Hey, I need to break my lease. Like, that's the knee-jerk reaction, right? Okay, yeah, I was going along, everything was fine. I didn't have tons of savings, but I could pay my rent, and then all of a sudden I have an event, and it goes to hell in a handbag. And
I think that's the key word. It's starting. Something's starting. Either a settling back to some new normal. I don't think it doesn't feel like a big slide backwards again, or a drop or a crash, but it doesn't feel like it can sustain to keep going up and up, certainly at the pace it was doing. So I don't know. We're in some sort of choppy up and down period.
Definitely, right? I would call it choppy, right? And then the Fed doesn't know what to do, right. And then will that continue to rock other aspects of the market? I would just say it's an uncertain time, and I would say you're going to have to stay tuned and see how it plays out. And
that's really the only good news for us is people have got to stay tuned. They can't just tune out for a while and come back and see how it is in 6 months here.
I guarantee you this, we fast forward 30 days, something else is going to happen, right? Yeah. Unfortunately.
It feels like it, yeah.
Not by my hand, but it's something else going to happen.
Yeah. All right. Well, we'll be on it the minute it does. Thanks for sharing this. I think We're still waiting for some answer, and the answer is still yet to appear. Up, down, good, bad, soft, hard. We'll find out. Stay tuned.
Yeah, and I would just say, as a closing thought on that for the viewers and the listeners out there, for those business owners, you're going to have to try and control costs and certainly monitor what's going on and keep a close eye on it.
And be nimble.
Yeah, and then for those employees that are out there, I would just say, if you have a good job and you like it, stick with it, right? and keep working hard so that you secure your job, because the idea of having a job, I think, will become more valuable as time goes on. For those investors out there that are still looking, that think there's better opportunities to come down the road, I'm going to sit on the sideline. I say, look, you wait for your opportunity, and then when it comes along, you take advantage of it. If you're waiting for interest rates to go back to 3%, that's not happening anytime soon. But you'll have to figure out how to make a deal and not do something just for the sake of doing it and then put yourself at risk. And for those that are looking at selling, the question then becomes, do I sell now? Do I wait? And I say, again, same thing. If you can sell it and get a reasonable price, do it and move on. If there's nothing pushing you to go sell, I guess you could wait, but tomorrow could be a worse day than today. So the simple answer is stay tuned, stay focused, right? Stay informed, and we'll be back here next week with more real estate. Thanks for tuning in. I'm Barry Saywitz, president of the Saywitz Company. Paul, thanks for playing along, and we'll do it again next week.
Okay. Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California, Irvine's Beale Applied Innovation Center.